We stand at the precipice of a definitive regime change in the global financial order. The first week of February 2026 has delivered a triple shock that is currently reverberating through every asset class, from sovereign bonds to precious metals. The convergence of a hawkish pivot at the Federal Reserve, a paralysis in the United States legislative apparatus, and a kinetic escalation in the Middle East has dismantled the investment playbook that defined the last decade. The nomination of Kevin Warsh as chairman of the Federal Reserve represents the most significant alteration to the monetary social contract since Paul Volcker. The immediate and violent repricing of the US dollar and the capitulation of precious metals signals that the market anticipates a return to positive real interest rates and a rejection of the debasement thesis that has supported asset prices since 2020. Simultaneously, the Pax Americana is being restructured into a transactional defense posture. The escalation of tensions with Iran, coupled with President Trump's landmark executive order prioritizing the warfighter, has fundamentally altered the equity valuation models for the defense industrial base, DIB. No longer can defense primes rely on financial engineering to drive shareholder returns. Capital allocation is now subservient to national security production targets. Domestically, the United States presents a fiscal paradox. While the government enters a partial shutdown due to legislative gridlock over immigration, the One Big Beautiful Bill Act, OBBB, is poised to unleash a historic wave of consumer liquidity via tax refunds in Q2 2026. This creates a massive dislocation between current sentiment, shutdown gloom, and future reality, stimulus boom, offering a rare window for strategic capital deployment. This report provides an exhaustive, granular analysis of these interlocking themes. It moves beyond the headlines to dissect the second and third order effects of these structural shifts, offering a roadmap for navigating the volatility of 2026. President Donald Trump's nomination of Kevin Warsh to succeed Jerome Powell marks a philosophical departure from the technocratic consensus that has governed the Federal Reserve for 2 decades. Warsh, a former investment banker and Fed governor 2006-2011, is distinct among modern central bankers for his skepticism of quantitative easing and his emphasis on financial market discipline. The market's immediate reaction, a 0.4% decline in the S&P 500 and a 0.7% drop in the Nasdaq, reflects a repricing of the Fed put. For years, equity investors operated under the implicit assumption that the Fed would intervene to arrest any significant market decline. Warsh's historical record suggests a different priority, the restoration of price discovery. Warsh's criticism of the post-2008 monetary architecture centers on the distortion of asset prices. He has argued that suppressing volatility encourages excessive risk-taking and misallocation of capital. By nominating Warsh, the administration is signaling a preference for hard money discipline, even if it entails short-term equity volatility. This aligns with the America First economic nationalism, which favors a strong, stable currency to attract global capital flows over the currency wars approach of competitive devaluation. The most consequential immediate impact of the Warsh nomination is the resurgence of the United States dollar, USD. The dollar index rallied sharply following the announcement, acting as a wrecking ball for commodities priced in the currency. This rally is not merely a function of interest rate differentials, it is a restoration of credibility. Global allocators are interpreting the Warsh nomination as a commitment to defending the real value of the greenback. In a world of fiscal profligacy where the U.S. deficit is expanding due to defense spending and tax cuts, the central bank's independence and hawkishness become the only bulwark against inflation. Warsh is viewed as the adult in the room who will prevent the monetization of the debt, thereby making U.S. Treasuries a genuine store of value rather than a certificate of confiscation. While the equity market frets, the banking sector stands to be the primary beneficiary of the Warsh regime. Warsh is a known advocate for regulatory rationalization. His private sector background and past comments suggest he views the post-Dodd-Frank regulatory environment as overly burdensome, particularly regarding capital requirements for large money center banks. We are likely to see a steepener trade emerge in the bond market. If Warsh maintains short-term rates to quell inflation, while deregulation unleashes economic growth, pushing long-term yields higher, the yield curve will steepen. This increases the net interest margin, NIM, for banks. Coupled with a potential rollback of the Basel III endgame capital surcharges, banks like JP Morgan Chase, JPM, and Goldman Sachs, GS, could see a structural expansion in their return on equity, ROE. The market has yet to fully price in this regulatory dividend, focusing too heavily on the interest rate risk. The first trading session of February 2026 witnessed a historic dislocation in the precious metals complex. Gold prices collapsed by 11% and silver plummeted by nearly 30%. To understand the magnitude of this move, one must recognize it not as a fundamental repricing of supply and demand, but as a liquidation event. For the past 3 years, the consensus trade among macro hedge funds and retail investors alike was long precious metals. This trade was predicated on 3 assumptions. The Federal Reserve would be forced to cut rates aggressively to service the national debt. Geopolitical instability would drive a flight to safety, gold. Central bank buying, China, Russia, would provide a floor. The Warsh nomination shattered the first assumption. If the Fed is willing to tolerate higher rates to defend the currency, the fiscal dominance thesis that the Fed must monetize the debt is weakened. When the investment thesis for a crowded trade breaks, the exit door becomes too narrow. The 30% drop in silver indicates forced selling, margin calls triggering automated liquidations in leveraged futures positions. In stark contrast to the metals crash, WTI crude oil prices held firm, rising to $66 per barrel despite the strengthening dollar. Typically, a stronger dollar exerts downward pressure on oil prices. The fact that oil decoupled from this correlation is a critical signal of physical tightness and geopolitical fear. The escalation of tensions between the US and Iran, specifically the threat of direct intervention, has introduced a substantial risk premium into the energy market. Traders are pricing in a non-zero probability of a closure of the Strait of Hormuz. While gold is a financial hedge against currency debasement, oil is a physical commodity essential for military and economic survival. In a scenario of kinetic conflict, gold cannot power a tank or a carrier group, oil can. This divergence suggests that the inflation trade is splitting. Financial inflation hedges, gold, Bitcoin, are vulnerable to monetary tightening, while physical scarcity hedges, oil, copper, are supported by supply chain fragility and war risk. As of February 1st, 2026, the United States government is operating under a partial shutdown. The funding provided by the previous Continuing Resolution, CR, expired on January 31st. It is crucial to distinguish the nuance here. 6 of the 12 appropriations bills, agriculture, military construction, etc., were already enacted. The shutdown impacts the remaining agencies, most notably the Department of Homeland Security, DHS, the State Department, and the Department of Labor. This partial nature creates a bifurcated economy. The exempt, the Department of Defense, DoD, operational forces remain active. Soldiers are on duty. However, the civilian support staff and the contracting officers who process payments are often furloughed. The impact. For government contractors, this is a liquidity shock. New contract awards stop. Modifications to existing contracts pause. Companies with high exposure to civilian agencies, e.g., Lados's exposure to DHS or health agencies, will face revenue recognition delays. Investors often make the mistake of thinking defense is safe. While the mission continues, the money stops flowing to the contractors for anything not deemed imminent protection of life and property. This creates a tactical shorting opportunity in government services firms with weak balance sheets that cannot weather a 30-45-day receivables delay. While the media focuses on the shutdown, a massive wave of liquidity is building just offshore. The One Big Beautiful Bill Act, OBBBA, passed in late 2025, creates a tax refund structure that will inject approximately $160 billion of additional capital into the U.S. consumer economy starting in March 2026. This stimulus is unique because of its delivery mechanism, tax refunds. Behavioral economics teaches us that consumers treat tax refunds differently than regular wages. Wages are used for recurring expenses, rent, food, utilities. Lump sum refunds are treated as windfalls and are disproportionately allocated to debt repayment, paying down credit card balances, bullish for banks, durable goods, purchasing electronics, appliances, and used vehicles, bulk consumption, stocking up at warehouse clubs. The timing creates a perfect bear trap. Markets may sell off in February due to shutdown recession fears, only to be blindsided by a consumer spending boom in March-April as the refunds hit bank accounts. This 44% year-over-year increase in refunds is a macro variable of sufficient magnitude to offset the drag from the shutdown. Strategic implication: the shutdown dip in February is a buying opportunity for consumer staples and discretionary retailers that cater to the median income demographic. Companies like Walmart, WMT, Costco, KOST, and O'Reilly Automotive, ORLI, are prime beneficiaries of this specific type of liquidity injection. The geopolitical temperature in the Middle East has reached a boiling point. President Trump's rhetoric regarding Iran has shifted from containment to direct threat of intervention. This is not merely posturing, it is being matched by the movement of carrier strike groups and the activation of readiness protocols. Historically, such tension would trigger an automatic buy signal for all defense stocks. However, the administration has introduced a new variable that fundamentally alters the risk-reward profile of the sector. Executive Order 14099. Issued on January 7, 2026, this executive order is a game changer for corporate governance in the defense industrial base, DIB. The order explicitly prohibits major defense contractors from conducting stock buybacks or issuing dividends if they fail to meet government-identified production targets and timelines. For the last decade, the investment thesis for companies like Lockheed Martin, LMT, and Northrop Grumman, NOC, was heavily reliant on their capital return programs. These companies often returned 100% of free cash flow to shareholders via buybacks to support their stock price, even as program delays, like the F-35 TR-3 upgrade, mounted. The EO ends this era of financial engineering. It forces capital expenditure, CapEx, into factories, supply chains, and workforce training. The risk. If a company like Boeing or Lockheed Martin falls behind schedule on a critical program, e.g. a hypersonic missile or a fighter jet delivery, their dividend could be legally frozen by the Pentagon. This introduces a binary event risk to these stocks that did not exist before. The opportunity. Capital will flow to operational alpha, companies that can actually manufacture at scale and on time. Given the specific nature of the threat, Iran's missile capabilities, and the EO constraints, the most attractive assets are those involved in missile defense and loitering munitions. RTX Corp, RTX. As the maker of the Patriot missile system and a key supplier for the Iron Dome interceptors, RTX is in the sweet spot. Their production lines are mature compared to next-gen hypersonics, reducing the risk of EO penalties. The demand for interceptors is effectively infinite in the current geopolitical climate. AeroVironment, AVAV. The shift toward attritable systems, Switchblade drones, favors smaller, agile manufacturers who can ramp production quickly without the massive lead times of a shipbuilder or aircraft manufacturer. AVAV is less likely to face the bloat scrutiny that plagues the primes. Taiwan, the canary in the coal mine. While U.S. markets obsess over the Fed, the most important economic data point of the week came from Taipei. Taiwan posted Q4 2025 GDP growth of 12.68% year-on-year. In a global economy that is generally slowing, a double-digit print from a developed economy is extraordinary. Taiwan is a monoproduct economy in this context. high-end semiconductors. This growth rate confirms that the demand for AI infrastructure, TSMC's advanced packaging, NVIDIA's GPUs, is accelerating, not plateauing. The AI bubble thesis is contradicted by the physical reality of wafer shipments. Warsh and the supply-side tech trade. Paradoxically, the hawk Kevin Warsh may be a friend to the AI trade. Warsh has frequently argued that the solution to inflation is not just crushing demand, higher rates, but increasing supply, productivity. He has cited artificial intelligence as a potential supply-side shock that could boost GDP growth without causing inflation. If the Warsh Fed adopts a view that good deflation, prices falling due to technology efficiency, is acceptable, they may be less inclined to hike rates purely to dampen a tech-led stock boom. This creates a safe harbor for mega-cap tech, Microsoft, NVIDIA, Apple. These companies have the cash reserves to ignore higher interest rates, they don't need to borrow, and the product alignment with the deflationary AI trend that the Fed chair favors. The sovereign cloud. The geopolitical fragmentation implies that nations will no longer trust foreign data centers. We are moving towards sovereign AI clouds. This benefits the infrastructure providers who build these distinct walled garden systems. The Trump trade in tech is not social media, which faces regulation. It is hard tech, semiconductors, data centers, and energy infrastructure required to power them. Strategic portfolio allocation, the Rodrik barbell. In light of the triple shock, monetary tightening, fiscal expansion, geopolitical conflict, the traditional 60-40 portfolio is dead. Bonds are no longer a perfect hedge for stocks if inflation volatility returns. We propose the Rodrik barbell for 2026. The offensive wing, inflation and conflict capture. This basket targets assets that benefit from nominal growth, conflict, and reindustrialization. Allocation. 50% constituents defense primes, RTX GD, hedged against the EO risk by focusing on mature production lines. Energy producers, OXY, CVX, the only hedge against a Strait of Hormuz closure. AI infrastructure, NVDA, TSM, capturing the 12% GDP growth signal from Taiwan. The defensive wing, policy and value capture. This basket targets assets that benefit from the OBBBA stimulus and regulatory relief. Allocation, 30% constituents, consumer staples, WMT, cost, capturing the 160B tax refund flow, U.S. financials, JPM, XLF, capturing the Warsh deregulation dividend, short duration treasuries, SHV, cash is a position, earning 4.25% plus risk-free, allows for dry powder deployment during volatility events. The hedges, the anti-fragile bucket, allocation, 20% strategy, short gold, silver, playing the unwinding of the debasement trade, short government services, non-defense, targeting contractors exposed to the shutdown duration risk.